Hi everybody. We are in week 2. I hope you had fun in week 1. We are starting to explore some really in-depth concepts here. So I don't want you to get frustrated if you heard something that you don't understand. I just had your buddies Kevin and Connor stop by my office and we talked in person about capital structure. So don't be afraid to do that, to call me. You guys know I love when you stop by to visit me anyway. Takima, who already has an accounting degree, so don't be intimidated, brought up the weighted average cost of capital. If you are interested in learning more, head over to her post and see the discussion that she and I had about that, another formula called WACC, W-A-C-C, weighted average cost of capital. That is a very advanced finance concept. We will discuss it a little bit in a further week. And if you're geeking out on finance, first of all, I'll be super impressed. And second of all, we can talk as much as you want about that because it's really cool when you start to think about this stuff. Finally, I promised that I'd give you a little verbal video tutorial on Yahoo Finance. So quickly, what happens is that there are really only 2 ways to start a business. You need money to start any kind of business, right? So you can begin a business with all the money yourself. Maybe you have a savings account and you have an inheritance or your parents give you money or whatever. So then your capital structure, the structure of all capital, which is money that it took to start the business, is 100% equity. So your capital structure is 100% equity. The other way that you can start a business, and if you watch my other video with the food truck, you'll see, is you can start a business by taking a loan. Warren Buffett doesn't like it, Chef Decker doesn't like it, but millions of companies do it, take on debt, okay? And if you do that and you have some equity and some debt, then you can come up with what percentage of your company is funded by equity and what percentage is funded by debt, and that, my friends, is your capital structure. Now, let's say that you need to raise a little bit more money. And you can either go out there and find investors, or like some companies do when they get big and popular and want to expand and maybe invest in technology or more stores or something like that, is they go public, right? What does it mean to go public if you're a company? Well, you issue an IPO, an initial public offering. You start selling little bitty pieces of your company, so that takes your company to a greater equity, right? Because if somebody owns a piece of your company, they have equity in your company. They have a stake in your company. So we are going to be looking at publicly traded companies. Now, the Securities and Exchange Commission has a law that if you are a publicly traded company, you need to submit your financial documents for the world to view quarterly. So you guys are going to look at a publicly traded restaurant since you are studying for a bachelor's degree in restaurant management. And this company that we are looking at right now is Chipotle. So Chipotle Mexican Grill, their call letters are CMG. If you put that CMG or Chipotle into the search bar when you pull up Yahoo Finance, it'll pull it up. I want you to click on that. And then you're going to see, you'll see a bunch of pictures. I think today, if you look at it, you'll see a stock price of like $670, but you'll see a negative in red, and you'll see a little chart that shows like the stock volatility, and you'll see that it's red today, which means that it's down from the previous reporting period. If you look tomorrow, it might be green. That's the stock market, okay? And to quote somebody who is really smart in finance, stock markets are like a roller coaster. And roller coasters would not be fun if they were a straight ride, right? What is an inherent characteristic of a roller coaster? Up and down. And the only people that get hurt on roller coasters, unless there was some sort of accident, are people who jump off. So it's a good idea to ride the stock market out and just know that there are going to be peaks and dips. So today is a dip day for Chipotle. And we don't know, if there is some sort of recall, if there is some sort of commodity that becomes really sparse, then that affects stock market, right, and stock prices. So you're starting to get a big picture on how all these current events and things that are happening can affect financials of restaurants. So I want you to look at this. Then there's a bunch of blue words right above that red picture of what the stock looks like today. I want you to scroll over about 2/3 of the way over and click on the word financials. Under that, you will see 3 financial documents that will kind of appear to the left. And it'll say income statement, which we've been talking about, me and you have been talking about for years. Balance sheet, which we talked about a little bit, right? That's where we find that accounting equation, assets equals like shareholders' equity, right, plus debt. And then we move over and we do statements of cash flows, which we're not going to do that much. Okay, so click on the income statement and you'll see a bunch of figures pop up. For this week's assignment, I'm going to have you looking at 2 ratios. I believe one of them comes from the income statement. And then if you click over to the balance sheet, it'll switch to you and you can pull the ratio information that I need from the balance sheet. Next week, you guys are going to be formatting cells, but don't worry, I'll show you how, so that you can become more fluent in not only reading and diagnosing, but creating ratios yourself based on information that becomes public information. Any questions? Text me, call me, or stop by and visit me. I'm still in Healy 226, unless I'm in 409, and I look forward to seeing you in the classroom. Bye, everybody.